If it feels like life in America gets smoother, faster, and cheaper the moment you already have money, you are not imagining it. In this video, we are going to break down exactly how that works using plain language and real data, so by the end you can spot the traps, understand the incentives, and make smarter money moves even if you are starting from behind. The big idea is simple. In America, a lot of systems are built to reward low risk, fast payment, and existing assets. If you already have cash, good credit, home equity, and a cushion for bad surprises, everyday life can feel almost frictionless. If you do not, the same life gets more expensive, more stressful, and full of penalties for being late, short, or tired. That is not just a feeling. It shows up in housing, debt, healthcare, transportation, fees, time, and even how inflation is measured. Start with the numbers that set the mood. The Bureau of Labor Statistics says average annual expenditures for consumer units in 2024 were $78,535, while average income before taxes was $104,207. That gap can make life look manageable on paper, but it hides taxes, debt payments, emergencies, and huge differences between households. At the same time, Census reported real median household income in 2024 at $83,730, not statistically different from the year before, which means many households felt like they were running hard just to stay in place. Now add wealth, not just income. Income pays bills this month. Wealth buys options. Wealth lets you pay a deposit without panic, fix a car without a loan, move for a better job, wait out a bad market, or say no to a bad deal. Federal Reserve distributional data for the third quarter of 2025 show the top 1% held about 30.7% of household net worth, while the bottom 50% held about 2.4%. That is the part many people miss. Two families can have similar paychecks, but if one family has assets and the other has none, they are living in different Americas. That difference becomes brutal when an emergency hits. The Federal Reserve's survey on household economic well-being found that in 2024, 63% of adults said they would cover a hypothetical $400 emergency expense using cash or its equivalent. That also means a large share would need to borrow, sell something, or simply would not be able to cover it right away. And once you have to borrow to handle small shocks, the cost of a flat tire or a prescription can multiply into interest, late fees, and missed work. Money does not just solve the problem, it stops the problem from spreading. Housing is the clearest example of why life feels easier if you already have money. The front door cost is massive. You need deposits, moving costs, application fees, time off to tour places, and often a stronger credit profile. If you want to buy, you also need a down payment, closing costs, cash reserves, and enough income to satisfy underwriting. If you do not have those things, you do not just wait longer. You often pay more while waiting because rents can rise and borrowing can get more expensive. The homeownership rate itself tells part of the story. Census reported the national homeownership rate at 65.7% in the fourth quarter of 2025, essentially unchanged from the prior quarter and the prior year. That sounds stable, but stability at the national level can hide a hard truth for would-be buyers. The door is not closed for everyone, but it is heavy. And it gets heavier when rates and upfront costs are high. And rates matter a lot. A widely used weekly mortgage survey showed that as of February 19, 2026, the average 30-year fixed mortgage rate was 6.01%, with the 15-year at 5.35%. That was down from a year earlier, but still high enough to change monthly payments dramatically compared with the ultra-low rate period many current owners locked in. If you already own a home with an older low rate, your housing cost can feel protected. If you are trying to enter now, you are buying into a different math problem. Home prices also do not wait for your savings plan. Federal Reserve economic data show the median sales price of new houses sold in the United States at $419,200 in the fourth quarter of 2025. Even if that number moves around quarter to quarter, the main point is the same. When prices are high, every extra month you spend trying to save can feel like the target is moving while you run. People with family help, prior equity, or investments that grew during the same period are not just richer on paper, they are faster in the race. Renting is not the easy alternative people imagine when housing is expensive. For many households, renting is the expensive holding pattern. A major housing report noted a record 22.6 million renter households were cost-burdened in 2023, meaning they paid more than 30% of income for housing, and 12.1 million were severely burdened, paying more than half. When that much income goes to rent, it becomes harder to build the emergency fund that would eventually make life cheaper. This is where the phrase, "it is expensive to be poor," gets real. If you can put down a larger deposit, landlords may see you as lower risk. If you have stronger credit, you may get approved faster or avoid extra conditions. If you can buy, fixed monthly payments can become more predictable over time while rents can reset. If you cannot, you may face repeated moving costs, deposit gaps, and lease renewals with less leverage. None of that is about personal worth. It is about how risk gets priced. There is another twist that confuses people during inflation debates. Many people look at home prices and mortgage payments and say, "Why does inflation look lower than what I am living?" Part of the reason is methodological, not imaginary. The Bureau of Labor Statistics measures shelter in the Consumer Price Index as a consumption service, mostly rent and owner's equivalent rent, not the purchase price of homes. The agency's own explanation also notes that mortgage interest, property taxes, most maintenance and improvement costs are treated as part of the capital goods side, not the shelter consumption item in CPI. So your personal housing pain can rise faster than headline inflation and still be consistent with how the index is built. At the same time, shelter still carries huge weight in CPI. The BLS Shelter Fact Sheet lists shelter at 35.625% of the CPI market basket as of December 2025, with owner's equivalent rent alone above 26%. That is why shelter often drives the overall number, and it is also why people argue so much about inflation in housing. Housing is both a lived expense and a measurement debate, and if you already own assets, you may experience the economy very differently from someone trying to enter. Look at the most recent price data and the picture gets even clearer. In the January 2026 CPI release, the All Items Index was up 2.4% year over year, but shelter was up 3.0%, food away from home was up 4.0%, electricity was up 6.3%, and medical care services were up 3.9%. Those are categories people use all the time, and several are hard to cut quickly. When you already have money, you can absorb these increases. When you do not, every percentage point becomes a trade-off. Now think about what money buys besides the thing itself. It buys timing. If you have cash, you can buy when there is a sale, pay annual instead of monthly, stock up before a price jump, repair something early before it fails bigger, and choose the cheaper option that takes planning. If you are stretched, you often buy in small amounts at the last minute and under stress. The unit price is higher, the fees are higher, the mistakes are more expensive. That is not bad character. That is what scarcity does to decision-making. Credit cards are a perfect example of the timing premium turning into an interest machine. The Federal Reserve's G.19 data, as shown in Federal Reserve economic data, put the commercial bank interest rate on credit card plans for accounts assessed interest at 22.30% in November 2025. If you pay in full every month, a card can be a convenience tool, maybe even a rewards tool. If you carry balances because wages and bills do not line up, that same card becomes a high-cost bridge. The same plastic, totally different life. And that difference spreads. A household with savings can use a card for points and pay it off. A household without savings may use the card for groceries, then pay interest on groceries for months. One side gets small perks, the other side gets finance charges. Over time, those paths drift apart quietly. No dramatic event, just compounding in opposite directions. Household debt data show how broad the pressure is. In the fourth quarter of 2025, the New York Fed reported total household debt rose by $93 billion to $18.04 trillion. Mortgage balances increased to $12.80 trillion. Credit card balances rose to $1.21 trillion. Auto loan balances reached $1.66 trillion, and student loans increased to $1.64 trillion. These are not tiny edge cases. This is the Main Street balance sheet. Notice what that means for the title of this video. Living in America can feel easy if you already have money because debt becomes optional, strategic, or cheap. It feels hard if debt becomes how you survive. When borrowing is a tool, you use it selectively. When borrowing is a lifeline, you use it repeatedly, even when the terms are bad. The system rewards the first and prices the second. Student loans show another version of the same story. Education is often sold as the path into the middle class, and it can be, but the cash flow timing still matters. People with family support can sometimes graduate with less debt, take lower-paid jobs for experience, move to expensive opportunity cities, or survive a bad first year. People without that support may need to work more while studying, borrow more, and choose faster income over long-run fit. The New York Fed's report also noted a jump in student loan delinquency transitions after the end of pandemic reporting accommodations, which is a reminder that payment schedules, policy resets, and credit reporting rules can hit hard when there is no cushion. Healthcare is another place where people say, "I have insurance, so why does this still feel so risky?" Because insurance is not the same thing as affordability. Census said about 92.0% of people had health insurance coverage for all or part of 2024, but coverage does not eliminate premiums, deductibles, coinsurance, out-of-network bills, time off work, or the cost of care before you hit a deductible. In other words, you can be insured and still financially exposed. The employer plan numbers are sobering. A major employer health benefits survey for 2025 reported average annual premiums of $9,325 for single coverage and $26,993 for family coverage, with workers contributing an average of $6,850 toward family coverage. It also reported an average deductible of $1,886 among covered workers in plans with a general annual deductible for single coverage. So even before anyone gets sick, a lot of families are already carrying a steady payroll deduction and a meaningful out-of-pocket threshold. Now let's zoom out. Federal health spending data show national health expenditures reached about $5.3 trillion in 2024, or $15,474 per person, equal to 18.0% of gross domestic product. Out-of-pocket spending was listed at $556.6 billion. When a country spends this much on healthcare, people with money can often protect themselves with better plan choices, cash reserves, and flexibility. People without money often manage the same system by delay, debt, and trade-offs. That is why easy in this title does not mean rich people never pay. They do pay, often a lot, but they can pay without losing the next month. That is the difference. A large bill is a cost. A large bill without reserves can become a chain reaction. Transportation works the same way. If you have money, you can live closer to work, own a more reliable car, do preventive maintenance, replace tires before they become dangerous, and pay for repairs before they cause a breakdown that makes you miss shifts. If you do not, transportation can become a constant tax on time and stress. A breakdown can cost wages, not just repair money. A longer commute can cost childcare hours, not just gas. And if you finance at worse terms because of weaker credit, the same car can cost far more over its life. Inflation does not hit all transportation costs the same way, which adds to the feeling that official numbers and personal life are speaking different languages. In the January 2026 CPI release, gasoline was down year over year, but electricity was up, transportation services were up, and airline fares jumped month to month in that release. That means one person may feel relief at the pump, while another sees rising insurance, repair, transit, parking, or travel costs. When budgets are tight, even mixed inflation can feel like all bad news because the categories rising may be the ones you cannot avoid. Food is another everyday example of how cash changes the game. If you have room in the budget, you can buy in bulk, choose stores with lower unit prices, cook at home more often, and absorb some waste when plans change. If your budget is tight and your time is tight, you may buy smaller packs, make more frequent trips, and rely more on prepared food. The January 2026 CPI data showed food at home up 2.1% year over year, while food away from home was up 4.0%. That gap matters because time-poor households are often pushed toward the more expensive option. And time is the hidden price in almost everything. Money buys time in America more than people realize. It buys delivery, yes, but it also buys fewer errands, cleaner credit files, shorter commutes, backup childcare, faster repairs, and fewer hours spent on hold fixing billing errors. When people say, "Why do wealthy people seem calmer?" One answer is that they spend less time fighting avoidable friction. Their bills auto-pay. Their emergencies are absorbed. Their choices are not all made under deadline. This is also why simple advice can sound insulting when it is missing the timepiece. Meal prep more. Compare insurance quotes. Refinance. Shop around. Negotiate every bill. Those can be good ideas, but they all require time, energy, documents, stable internet, and the mental bandwidth to plan ahead. A person working long hours, commuting far, or juggling care work may know the cheaper option and still be unable to reach it. Now let's talk about fees, because fees are where the system quietly punishes instability. A late fee is often not just a price. It is a signal that you lost the timing game. An overdraft fee, a returned payment fee, a rush processing fee, a reconnection fee, a missed appointment fee, a convenience fee, a change fee, a transfer fee, a fee for paying monthly instead of yearly, a fee for not being able to float the cash. These are all different versions of the same thing. The cheaper path was available, but only if you had cash, time, or both. Federal consumer finance data show that fee practices can change quickly when there is pressure, which tells you how important fees have been. The Consumer Watchdog reported that among large banks, most non-sufficient funds fee revenue had been eliminated in recent years, estimating nearly $2 billion in annual savings from those changes. And another data spotlight showed reported bank overdraft and non-sufficient funds fee revenue in 2023 was sharply lower than pre-pandemic levels. That is good news, but it also reveals how much money was being extracted from people who were already short. The same agency has an entire junk fees initiative, and the broader point is not just about one fee type. It is about design. When prices are split into base price plus add-ons plus processing plus optional but not really optional extras, the people with the least slack pay the highest cognitive cost. They spend more time comparing, more time undoing mistakes, and more money when they cannot. Here is a hard truth people do not always say out loud. Wealth often gets a discount because it reduces risk for the seller. Landlords, lenders, insurers, and merchants are all trying to avoid non-payment, fraud, defaults, returns, and service costs. A customer with cash, strong credit, and a long, stable history is cheaper to serve. The system then returns that lower risk as better terms. That is logical from a business view. It is also how inequality can widen without anyone breaking a law. Insurance is another place where money changes the experience, even before rates enter the picture. If you have savings, you can choose higher deductibles and lower premiums in some cases because you can absorb the hit if something happens. If you do not have savings, a high deductible can be dangerous, but a lower deductible plan may require higher monthly payments that are hard to carry. So the best option depends less on the sticker and more on your buffer. Same market, different reality. The same logic shows up in phones, internet, utilities, and household basics. Annual plans can be cheaper than monthly. Auto-pay discounts can be real. Buying a durable product once can beat replacing a cheap one repeatedly. But all of those smart savings often require cash up front. People without spare cash get pushed into the higher monthly cost version of life, where the headline price looks lower but the long-run cost is higher. People also underestimate how much geography matters. If you already have money, you can choose neighborhoods with shorter commutes, safer streets, better schools, more reliable services, and better grocery options. If you do not, location is often chosen by what is available this month, not what saves the most over 5 years. Then the location itself can increase costs through more driving, fewer options, and more time spent getting to everything. Money does not just buy nicer things. It buys access to lower friction systems. There is a labor market version of this too. Someone with savings can wait for a better job match, negotiate harder, and survive a gap. Someone without savings may need the first offer, any shift, any schedule, any location. Over time, the person with flexibility can build a career ladder, while the person under pressure is forced to optimize for immediate cash. Again, this is not about work ethic. It is about bargaining power under time pressure. Even inflation wins can feel unequal. If gasoline drops but your rent renews higher, your health premium rises, and your childcare costs do not budge, the macro story may sound better than your life. The January 2026 CPI release showed exactly this kind of mixed picture, with overall inflation lower than earlier peaks but several service categories still running hot. People with money can smooth through that. People without money feel the hot categories first because those are the ones that get paid every month, no matter what the headlines say. Let's go back to housing for a moment because this is where many people think the problem is only prices. Prices matter, but structure matters too. Existing owners who bought earlier often have lower fixed mortgage rates, and some have seen their equity rise. That can create a lock-in effect. They are not eager to move into a higher rate environment. New buyers then face tight supply, high prices, and rates that make payments heavier. So money helps not only because it buys a house, but because getting in earlier can protect you from later conditions. Renters feel a different version of lock-in. If a place is barely affordable but the move would require a new deposit, movers, application fees, and utility setup costs, staying can be the only option even when rent rises. A household with more savings can move strategically. A household with less savings often moves reactively or not at all. That difference changes negotiating power before any lease conversation even starts. Another thing people miss is how many good decisions depend on having made earlier good decisions that were only possible with resources. Good credit usually comes from on-time payments over time. On-time payments over time are easier when income is stable and emergencies are absorbable. Stability builds better terms. Better terms create more stability. That loop can work in your favor or against you. The same loop exists with healthcare. Preventive care sounds simple, but it requires scheduling freedom, transportation, and confidence that the bill will not explode. If you have money, catching problems early is easier. If you do not, care gets delayed, conditions worsen, and the final cost can be higher in both money and health. A system can be technically available and practically out of reach at the same time. This is why personal finance advice that starts and ends with budget better often falls flat. Budgeting matters. A lot. But budgeting cannot erase a weak starting balance sheet. It cannot turn a 6% mortgage environment into a 3% one. It cannot make a deductible feel small. It cannot create a down payment by sheer discipline if rent is already taking too much income. The data on cost-burdened renters and household debt make that clear. At the same time, it would also be wrong to say individuals have no agency. They do. The point of understanding this system is not to give up. It is to stop blaming yourself for every friction point and start focusing on the moves that actually change the math. Sometimes that is increasing income. Sometimes it is reducing a high-interest balance. Sometimes it is building a tiny emergency fund before investing. Sometimes it is choosing stability over appearances. The right move depends on where the leak is. A lot of people also confuse visible wealth with useful wealth. A high income with no cash reserve can still be fragile. A modest income with low fixed costs and a solid emergency fund can be surprisingly resilient. What makes life feel easy is not just income level. It is the combination of liquidity, low-friction obligations, and flexibility. In simple terms, it is how many bad surprises you can handle without borrowing. That is why the Federal Reserve emergency expense question is so revealing. It is not asking whether people know what they should do. It is asking whether they can do it right now. The gap between knowing and being able is where a lot of American stress lives. And once you see it, you start noticing it everywhere. Better prices for paying in full, better terms for higher credit scores, better neighborhoods for higher deposits, better healthcare access for flexible schedules, better jobs for people who can wait, better returns for people who can stay invested during downturns. The market keeps offering discounts for stability, and money is one of the fastest ways to buy stability. There is also a psychological side that matters. If every month feels like a timing puzzle, you are more likely to choose the option that removes stress today even if it costs more later. That is rational in the short run. The problem is that many American systems monetize short-run relief. Installment options, rush services, convenience charges, and rollover debt all feel like help in the moment because they are help in the moment. They just often come with a future bill. This is why saying wealth compounds is not just an investment statement. It is an everyday life statement. Wealth compounds through lower borrowing costs, fewer fees, better housing options, better job flexibility, and more time. Poverty can compound too, through penalties, instability, and expensive coping strategies. The compounding is not always dramatic. Sometimes it is just a few extra charges and a little less sleep, month after month. The good news is that once you understand the mechanics, you can make smarter choices about what to fix first. A lot of people chase visible upgrades while ignoring the hidden friction that drains them. But the biggest quality of life improvements often come from boring moves. A small cash buffer, automatic bill timing, reducing one high-interest debt, preventing one recurring fee, or choosing the plan that lowers volatility instead of the plan that looks cheapest at sign-up. Those moves do not make a flashy post, but they can make life feel less punishing. And if you are already doing well financially, this analysis still matters. It explains why advice that worked for you may not transfer cleanly to someone else. It also helps explain why entire groups can appear to make bad choices when they are really choosing among bad options under time pressure. Looking at the structure does not erase responsibility. It gives context to responsibility. This is also why public debates about inflation, wages, and the economy can sound so disconnected. One person points to a strong job market. Another points to rent. One points to stock gains. Another points to grocery runs and medical bills. One points to the headline CPI. Another points to a mortgage payment quote. They may all be telling the truth about their own balance sheet. The data are shared, but the experience is filtered through assets, debt, and timing. So when someone says, "Living in America is easy if you already have money," the serious version of that statement is not just envy. It is a systems observation. Money reduces exposure to the parts of the economy that charge you for being unstable. Money gives you access to the versions of products and services that are cheaper over time. Money buys recovery time when something goes wrong. And in a country where small shocks can trigger big consequences, that matters more than people admit. If you want one sentence to remember, here it is. In America, the same item can have different total prices depending on how much cash, time, and margin you already have. The sticker is only the beginning. The real price includes financing, timing, fees, stress, and what happens if one thing goes wrong. That is why two households can earn decent incomes and still feel miles apart. One is using money to buy convenience and lower risk. The other is using debt and time to patch gaps. One gets compounding relief. The other gets compounding friction. Until that changes, the phrase in this title will keep sounding true to millions of people. So the biggest takeaways are clear. Housing remains the largest pressure point for many families, with high entry costs and widespread rent burden. Debt becomes far more dangerous when it is survival debt instead of strategic debt. Healthcare coverage does not erase out-of-pocket risk. Inflation can look moderate overall while still hitting hard in the categories people cannot easily cut. And the hidden advantage of money is not just luxury. It is lower friction, better timing, and fewer penalties. If this changed how you think about easy and expensive, hit like, share this with someone who always says, "Just budget better," and tell me in the comments which part hits hardest in your area right now: housing, healthcare, debt, food, or transportation.